For the better part of a decade, the financial world operated on a specific assumption. Bitcoin was our modern crisis insurance. The theory was that when panic hit the markets, Bitcoin would step up and act exactly like digital gold. This chart shows how that theory performed when put to the test in early 2026. Look at line A, physical gold surging past $5,300 an ounce. Now look at line B, Bitcoin chopping sideways and dropping 30% from its previous peak. The numbers confirm the divergence. The correlation coefficient between these two assets recently hit negative 0.88, the lowest level since the 2022 bear market. This leaves investors with a serious question. Has Bitcoin failed its primary use case, or have we spent the last 10 years misunderstanding the actual job it performs in a portfolio? The 2026 data shows that the two assets are no longer moving as substitutes. We are seeing a structural decoupling. Gold has reclaimed its position as the primary geopolitical bunker, a physical asset that central banks and institutions hold when the global system shakes. When you look at the 2026 landscape, armed conflicts in the Middle East, central bank accumulation, and fiercely sticky inflation, capital is moving into physical crisis insurance that doesn't rely on a software update. Bitcoin is reacting to a different set of inputs. Instead of a safe haven, it is trading more like a high-performance tech proxy. Take a look at this graph showing global M2 money supply alongside Bitcoin's price. When liquidity flows into the system, Bitcoin acts as a sponge, expanding in near-perfect synchronization with the money supply. To prove the connection, we can replace the M2 line with the Nasdaq Equity Index. The correlation here recently spiked to positive 0.72. Bitcoin tracks risk sentiment, not fear. These two assets have different roles. One is a crisis bunker. The other is a high beta tracker for global liquidity. For the modern investor, executing this theory means choosing between two very different tools. First, the bunker. This means allocating capital to physical gold bars or traditional gold ETFs, like IAU. This guarantees purchasing power preservation and immunity to technical hacks. The trade-off is that it yields 0% and offers no upside from digital innovation. On the other side is the sponge. This involves purchasing low-fee spot Bitcoin ETFs, like IBIT, FBTC, or BITB, through a standard brokerage account. This gives you price exposure to the emerging digital financial infrastructure. Over the last 12 years, Bitcoin's returns have outpaced gold by 65 times, representing an asymmetric growth opportunity that traditional assets haven't matched. But that growth comes with a cost. This matrix shows the volatility trade-off. Spot Bitcoin ETFs face drawdowns up to 70%,